In this lesson, we'll talk about costs of inflation. In other words, why inflation is a problem, why policymakers are trying to achieve a low and stable inflation. When we discuss costs of inflation, we usually split these costs into two types: costs of predictable inflation and costs of unpredictable inflation. This will be totally different, totally separate effects on the society and the economy. The thing is, if people can predict the rate of inflation correctly, even if it's high, but they can forecast it, this means that they're fully able, they're perfectly capable of taking this future inflation into account when making their business decisions. And as a result, the cost of inflation will be relatively small. If you know that inflation is positive, it can be 2%, can be 20, or even 200%, but it is relatively stable, it's always 200%, and you can forecast this, you will be able to incorporate this into your future decisions. For example, you will be able to adjust your future contracts, labor contracts, contracts to supply materials, contracts with your customers. You will be able to incorporate this future price growth. You will know that the cost of your materials will increase by 200%, for example. You know that your staff will expect a 200% increase in their wages, and you know that you can incorporate this price increase into your contracts to supply your products to the customers, and as a result the cost will be relatively small. And these costs include two main types, so-called menu costs and shoe leather costs. What are the menu costs of inflation? The thing is, when inflation is high, companies might need to adjust their prices frequently to take this price growth into account. For example, if you're a company which trades by relying on catalogs and menus, for example, you are a company like Argos, which prints and distributes catalogs listing all their products with current prices regularly, for example, once per quarter. These catalogs, printing these, preparation of these catalogs printing will involve some costs of production, and to distribute them you will also need to incur some expenditure. When prices increase quickly, you might need to print more catalogs, update them more frequently, which will require extra expenditure. This is what is called menu costs. If you're a restaurant and you need to update your prices every month, you will need to reprint your menus every month. You might need to reprogram your till software. You might need to change price tags on all of your inventory. When prices grow quickly, you might need to change these price labels frequently, and this will incur additional expenditure. These are extra costs. These extra costs are called menu costs. Generally, they are relatively small. That's not such a big deal. Another type of cost of predictable inflation is so-called shoe leather costs, which include costs of time and effort which people spend trying to find the best deals. The thing is, when inflation is high, companies will adjust their prices, but they will do this not in the same manner. They might not increase their prices by the same amount on the same day. And if you are trying to buy a high price item, for example, a laptop, you might come across a product which has not increased in price just yet. One company maybe has lifted the prices for their inventories for 20% last week, but another company tries to do this or plans to do this only this week, and as a result you might get a laptop at 20% cheaper price compared to elsewhere. So you will try to find these deals, and this extra time which people spend trying to counteract the effect of this inflation will be called shoe leather costs. For example, if prices increase very quickly, the purchasing power of your money will diminish quickly as well, and if you used to carry, let's say, 50 pounds in your pocket, now you will try to hold less cash because it loses its value so quickly, and you might need to carry only 10 pounds because otherwise you will just lose purchasing power. You might need to withdraw cash from the bank more frequently, and again this will require some time. So as a result, this is what is called shoe leather costs. This is just a traditional name for this type of expenditure, this type of cost of predictable inflation. However, when inflation is unpredictable, when people cannot forecast the rate of inflation correctly, this is where the problems lie. This is exactly the reason why governments and central banks are trying to tackle inflation and keep it at a stable level. The problem is, the higher the inflation rate, the more variable it tends to be. If our inflation is low, around 2%, so what can we expect? It can be maybe 1.5% or 2.5% only. The variation in inflation will not be this dramatic. While if a country suffers from 1,000% inflation, it can vary by a lot. It can fluctuate between, let's say, 500 and 5,000%. And in other words, it can be much more variable when it is high. And when it is variable, it becomes much more difficult to predict what price growth you will experience in the future. And as a result, consumers, firms, as economic agents simply don't have enough information and forecasting skills to be able to incorporate this future inflation into their decisions. As a result, they are not able to fully adapt to it, and this will lead to much higher costs to the economy. So first of all, the most obvious cost of unpredictable inflation is the loss of purchasing power of consumer earnings. The thing is, when prices grow, the actual real purchasing power of your income will decline. So for example, in January, you were able to purchase a certain amount of physical products for your salary. By December, prices have increased, and if you stay on the same income, which tends to be the case, you sign a labor contract, and companies tend to reconsider the wages they pay to their staff on regular intervals, but this definitely won't be every month. They can increase your wages, let's say once per year, or maybe at best once per quarter, but prices grow every month, and as a result, by December, the purchasing power of your income has been eroded by higher prices, so you will be left worse off as a result of this. Standards of living will decline. You will be able to purchase less for your income simply because all goods are now more expensive. Apart from this, another important problem which will affect another part of the society, another part of the economy, is lack of investment. The problem is investors don't like uncertainty. When inflation is so high, you cannot predict the costs which you will incur in the future. You cannot predict your future revenue. You don't know what price consumers will be prepared to pay in the future because prices for different goods grow at different rates. You don't know what your costs will be, what your revenue will be, which implies that you are unable to forecast your future profits and earnings, which means that you don't know whether your investment project is going to be profitable or not. And as a result, this will discourage investments. You don't want to invest in a company or in an economy or in a project if you don't know whether you will earn any money from this investment or not. So you will avoid these investment projects. As a result, investment level in the economy will decline, which will reduce the rate of future economic growth. Lack of investments undermines our future production potential and future standards of living. This is a serious cost of inflation. Next, quite unexpected effect of unpredictable inflation will be redistribution of income. The thing is, when inflation is high, wealth will be distributed away from people on fixed income, they will be worse off, towards those who can renegotiate their pays, rents, profits, and so on in regular intervals. Imagine that you work for a company which changes or updates labor contracts once per 5 years. You sign a labor contract and you will be stuck with a particular salary for 5 years. If inflation is high, by the end of this 5-year period, the real purchasing power of your income will be very low because everything has increased in price dramatically. While if you are able to renegotiate pay rises frequently, let's say every month, you will be compensated for this price growth. If prices increase by 10% monthly and your wages increase by 10%, then it's okay. Then you don't lose out. You will be better off in this particular situation. So as a result, high and unpredictable inflation can lead to redistribution of income within the society. Moreover, it will also discourage savings because it will shift wealth away from lenders or savers, those people who save money, towards borrowers who are who are able to pay a fixed percent or who are staying on fixed interest rate contract. The thing is, if you save some amount of money, let's say you worked hard and you saved £1,000 and you put it in a bank account at, let's say, 2%, but inflation in the economy is 10%, it means that even if you're earning some interest on your savings, you still lose about 8% every single year in real terms. So generally, there will be no incentive for you to save money. Well, this situation benefits borrowers because you borrow £1,000 at 2%, but by the end of the year, the real value of your debt has declined. Inflation diminishes the real purchasing power of your income, but it also reduces your debt in real terms. And if you are able to borrow a substantial sum of money on a fixed interest rate, which is lower than inflation, you will benefit in the longer term, because by the time when you will need to repay this debt, inflation would have reduced the actual value of this debt dramatically. Again, this results in a lack of funds for investment. High inflation discourages savings. There is no point saving money if they lose purchasing power. It makes sense to spend them now while you can. And this will also reduce the actual value of your pensions and so on, which will again undermine future growth and future standards of living. Apart from this, it can also lead to negative effects on the balance of payments, which is likely to worsen. We'll have a separate lecture on balance of payments, which is simply a record of all international transactions, all trades between our country and the rest of the world. The thing is, when inflation is very high, it implies that our exports, the costs of our products, become very expensive for foreigners, which will make them less competitive in international markets. When price for our goods go up quickly, they become very expensive, and as a result, foreigners will find that it's too expensive to buy our products, so our exports will go down. On another hand, when our goods are so expensive, it makes imports more attractive. They become cheaper in relative terms compared to domestic products. If our prices for our products have increased dramatically, and if our inflation is higher than abroad, it will be more cheap. It will be cheaper for us. It would make sense for us, more rational for us, to buy imported goods. They are cheaper for consumers, and as a result, imports will increase. So what will happen? Exports will decline because our goods are too expensive for foreigners, less competitive in international markets, while we buy more imports. So net exports will go down, which will lead to a reduction in aggregate demand. Recall the formula for aggregate demand. Aggregate demand is a sum of consumption plus investment plus government expenditure plus net exports, which is the difference between exports and imports. When exports drop and income increases, this will lead to a reduction in net exports. Net exports drop, and if one of the components of aggregate demand drops, aggregate demand will drop as well. So as a result, what we will experience, we will have a lower aggregate demand. Aggregate demand curve will shift downwards. New aggregate demand will be lower, which will lead to lower national output. So generally, as you can see here, we will have negative effects of inflation affecting very different layers of the society, different parts of the society. Inflation will have many different negative effects on consumers, on investors, on trade with the rest of the world, on social issues, distribution of income, and that is why low and stable, importantly stable, predictable inflation is one of the major macroeconomic policy objectives for majority of countries.